Right. If a company is selling DDP to consumer in Canada under a non-resident importer casual sale, do you need to file a quarterly report on GST, even if actual GST was paid at time of import?
Yes, yes. The difference between the quarterly report and the GST at time of import. The GST at time of import is attached to your customs entry, and that's 5%, regardless of where you're entering into Canada. Your quarterly report is attached to your sales invoice. So when you're selling the product to the individual for $100, then you're collecting from the individual the tax that's applicable depending on his province, right? So that's based on your sale. I'll give you an example. You're selling to someone in the Maritimes, $100, then you would have $15 of tax to charge to them for a total invoice of $115. Now, at time of entry, when the goods cross the border, we paid 5%. This is the 5% that becomes your tax input credit. And when you're filing your report, you would go, I sold for $100 plus $15. So I owe the government $15 of tax that I collected on their behalf. But I paid $5 at time of import. So that $5 becomes your tax input credit and allows you to only send $10 at the end of the 3 months or on your report. So yes, you would want to definitely, if you're registered on any transaction you want to.
So it's really that quarterly report. I mean that you're doing. It's a reconciliation to make sure that all the taxes are correct. So if I'm my understanding is if I'm shipping to one of the provinces that is just a 5% GST.
Yep.
I pay that 5% GST at the time of importation, and then I still have to do my quarterly report. But in my quarterly report, I say I owe 5%, right. I paid 5%, I'm at 0.
Correct.
I'm at nil.
So your report at basically that would be a nil report, just saying I sold, I collected 5, but I paid 5, so it's 0.
0. So and which said is that if I'm going to say a maritime province, that's 15%.
Right.
On my quarterly report, I say I owed 15% of my top sales of my sales into Canada.
Correct.
I only paid 5% because that's the GST that's collected at import.
Right.
So I still owe an additional 10%.
Correct. And
then I have to make whole what I did with Canada.
Correct.
So let's talk about, just because I think this is a great segue into it and to help people understand it, what else can I file on that quarterly report to maybe help out, to make sure that I'm taking advantage of all my import credits? Well, maybe things people aren't thinking of.
As an example, if I go up to Canada to meet my customers, I spend a week there, I have a hotel bill, I rented a car, I pay taxes on the hotel bill and the car rental and everything. So you have paid taxes within your normal business process. So when you're filing your quarterly report, you're going to say, okay, I sold $100, I owe you $15 because it was maritime provinces. At time of entry, we had that $5 that we paid at time of entry, but I have $400 worth of taxes here that I paid on my hotel bill, my car rental, and so on. Well, that's a tax input credit as well. So you would actually say, I owe you 15, but I actually paid $405. So I want the difference back, and that would be a tax return where you would be getting money back actually in that particular sale.
Perfect. No, that's great. That's because I think people, we think of the transaction itself and not the cost of doing it, and the way Canada does their input credits, that's applicable. So
it's applicable. So
watch your line items and collect your bills and make sure you're
whatever taxes you've paid in Canada in the process of doing business. Of course, if you came up to Canada on holidays, it's not the same thing. But
all right.